Welcome to GNCC Espresso Live. My name is Mishka Balsom and I will be your moderator for the next hour. When entrepreneurs start planning for the business, the question of what happens to your business after you stop working are naturally not the first things on one's mind. But succession planning is an essential element for ensuring a business success, as it is to have a proper business plan for running the business. All of us have learned over the past 4 to 5 months, life can be unpredictable, and planning for different outcomes is essential for business success. The number of businesses that don't have a succession plan in place is quite high. Most often, businesses think a written plan is not needed, and the consequences of not having a succession plan in place are not properly understood. But the benefits of having a proper succession plan are enormous. And we are very fortunate this morning to have with us 2 experts in this field. Jeff Halpern, Chartered Professional Accountant, Chartered Accountant, is a seasoned cross-border tax and estate wealth planner and planning advisor and career international banker. Jeff has lived in North America, Asia, and Europe, advising business owners across the globe on holistic tax, estate, and succession planning solutions. Jeff relocated back to Canada to join TD at the end of 2011 to help launch TD's Business Succession Advisory Service, where he's an advisor to the bank's most successful business owner clients. Jeff holds the designation of Trust and Estate Practitioner and sits on the Global Professional Standards Committee and Toronto branch executive of the Society of Trust and Estate Practitioners. Jeff recently obtained his Family Enterprise Advisor designation, and he is also the Schoolish Business School and sits on the Dean's International Advisory Council. And we have with us Aaron Gillespie. He is a partner at KPMG's Hamilton office, specializing in Canadian tax compliance and advisory services, with a focus on large Canadian-controlled private corporations. Aaron has extensive experience with tax planning, debit, remuneration planning, estate planning, corporate reorganizations, and various tax minimizing strategies. With over 160 professionals and support staff in the Hamilton, Opal, and St. Catharines offices, KPMG has the resources required to provide a full range of services. They have the strengths of their national and international member firms, but with a local touch. And KPMG is proud to work closely with their clients, helping them to manage risk and take advantage of opportunities. Both gentlemen work directly with businesses with a profile of $3 million or higher. But before we get into our conversations with Aaron and Jeff, we're being joined by Scott Galbraith, District VP of TD Commercial Banking, providing us with some introductory remarks. Scott, over to you.
Good morning. My name is Scott Galbraith, and I'm the District Vice President for TD Business Banking, covering the Niagara Peninsula. It is our continued pleasure to come to you as the sponsors of the GNCC Espresso series. It's our second time doing it in this manner, something we're still getting used to, as you can see. It's our pleasure to continue to assist in providing valuable information to those of you in the business community, and to continue supporting everyone through these uncertain times as we enter phase 2 and beyond, hopefully. We hope you enjoy the content of today's presentation as provided by TD and our friends at KPMG as it pertains to succession planning, tax advice, and otherwise. If you do have concerns or questions about banking or anything related to TD, certainly feel free to reach out to myself or Jennifer Monaco, whose information will be provided at the end of the presentation. Jen is the relationship manager for TD, covering the peninsula. Thanks again to Mishka and everyone at the Chamber for the invitation to continue to participate, and we hope you enjoy the presentation. Thanks very much.
Thank you very much, Scott. Really appreciate our partnership that we have with you. Jeff and Aaron have prepared a brief presentation, which will be followed by the more interactive component of the webinar, which are answering your questions, the questions of all the attendees and participants in today's webinar. So, Jeff, over to you for the presentation part of it.
First of all, thank you very much for inviting me to speak this morning to your members. The subject of business succession planning is extremely important because many things can happen in our lifetime to disrupt our plans. And so by having a plan and understanding what goes into a plan, we're all a little bit better prepared. Now, for most families who own an operating business, the business is probably the most valuable asset that they own. And in the absence of planning, a lot of things can go wrong and you can miss a lot of opportunities for the planning that's available. So this morning's presentation is really oriented towards defining what a business succession plan is, describing when the right time is to transfer your business. We'll examine some of the business transition options that are available. We'll talk about how to keep the business in the family and some of the family issues that arise to challenge the ability to keep a business in the family. And we'll turn it over to Aaron to talk about estate planning and some advanced tax planning considerations. At TD, we define a business succession plan as a plan to establish the framework for the future transfer of two things: ownership and management of your business to a chosen successor. Now, very often, the transfer of ownership and management go hand in hand, meaning you sell your business or you transfer your business to someone who both becomes the owner of the business and also the key management of the business. But sometimes they separate. For example, I had a very successful business owner who owned a car dealership. And he had children who worked in the business, but they weren't capable of actually managing the business. They had secondary roles. But the business was so successful, they wanted to keep it in the family. And in that particular case, what they decided to do was to bring in professional management to run the business, but to keep the children as the owners of the business, to keep the family as the owners of the business. You can, in fact, separate the ownership and the management in certain circumstances as well, if that makes the most sense. But besides being the plan to transfer the ownership and management, the important thing about a business succession plan is that it really is intended to basically prevent any type of misfortune that might arise, either disagreements between family members or certain circumstances in life to arise that could jeopardize the successful transfer. Questions to ask yourself before you are planning the transition for the business is, do you know when you want to exit? How much is the business worth? And can we increase the value before an exit? And if you have enough time, absolutely you can increase the value before an exit, because there are certain valuation metrics that business succession advisors like myself and Aaron talk about that can give you insight into how to change the value of the business before the exit. Do you know how to go about selling your business? Well, we're going to talk about that in today's presentation a bit. Is your family protected in the event of a death prior to exit? You know, a lot of people, Mishka, are not aware of the fact that in Canada, we don't have an estate tax like they have in the United States, but we have something that's almost as bad. We have something called the deemed disposition. In Canada, the Income Tax Act does not tax you on the growth and the value of assets that we have until we actually crystallize those gains by selling the assets. But there's another provision in the Income Tax Act called the deemed disposition, Mishka. And that provision says that when we die, we're deemed to sell all of our assets at fair market value. And it can cause a very, very big tax bill for families that, in the absence of advanced planning, could be something that could disturb the ability to pass the business down to the next generation. So advanced planning and a recognition of some of the taxes that arise at death are extremely important. Have you done all the available planning to minimize taxes on exit? If you do advanced planning, you can really reduce the tax bill substantially. And Aaron is going to talk about some of the advanced planning that is possible today. Has a successor been groomed? How can we assure family harmony when bringing successors into the business? So these are all very common questions to ask in advance. When is the right time to plan for a transfer? Well, clearly, the right time is in advance of a planned retirement or before illness strikes. If liquidity is needed by the family to diversify risk, a lot of families, the major asset that they own is the business, and therefore they have a lot of concentration of wealth in that asset class. So you can diversify risk by selling off or doing some recapitalization of the business and reinvesting some of the money that you get from recapitalizing the business. If the successor is groomed and ready, you have to take advantage of that moment in time, because sometimes people get frustrated and leave the business. if there are strong capital market conditions or declining business conditions on the horizon. Mishka, we've seen some tremendous impact of the COVID crisis on the valuation of businesses. Certain businesses are valued more today than they were pre-COVID. Other businesses are valued less today. So market conditions can have a dramatic impact on the timing of a transfer. If partners are getting anxious about the succession, or if there are other interested parties getting anxious about the transition, things like customers and suppliers getting anxious if the owners are getting too old. Who can help sell the business? Well, typically it's business brokers, mergers and acquisition specialists, consulting arms of accounting firms, and lawyers. Now, not all professional advisors deal with all business sizes. Most people have an appetite for a certain minimum size of business. Therefore, it's important to understand the business dynamics and the business valuation in order to then match it to the appropriate channel of a consultant to help to sell the business. And size does matter. Size matters in a variety of different ways. Smaller businesses can be more difficult to sell because perhaps there are fewer professional advisors who are willing to take on a smaller business. But similarly, larger businesses command a much larger valuation in terms of the sale of the business. Why? Because clearly there's fewer businesses that are actually larger and more profitable than there are the smaller businesses. So in that pyramid shape, the fewer businesses at the top of the pyramid command a much larger multiple of earnings in terms of the exit. You can get a very large premium depending upon the size of the business. So a lot of people who are thinking about planning the exit of their business also should keep in mind, can they grow the business to move it up in the pyramid to get that higher multiple on the exit before they actually exit their business? There are many ways to exit your business when you feel the time is right. For example, you can sell your business to an existing partner or an existing shareholder. That's very common when we have businesses that are owned by multiple partners. You can transition the business to a family member. You can do a management buyout. So if the management team is interested to buy you out, they can actually buy out your shares, and that provides a continuity to the management in terms of the ownership. You can have a third-party sale to a customer, a supplier, or a competitor. These days, we have a lot of financial investors, typically referred to as private equity firms or search funds. These are financial investors who are looking to buy businesses where they can bring professional management to the table to take over the business and grow the business. So their goal is to buy a business, invest in it, and then possibly to exit in a period of 5 to 7 years or longer. Going public historically was an option that some businesses chose to take, like the Walton family when they took Walmart public. But today, going public is something that we see less because of the complexities and costs of maintaining public companies. Now, Mishka, I will mention the fact that sometimes we see business owners where the business is really them. It is the owner themselves. The owner is the chief financial officer, the chief sales officer, the CEO, and essentially, if they leave the business, there is no business any longer. And in those cases, what you have is a business that hasn't got the infrastructure, the foundation of middle management to sell to a buyer. And sometimes we see those cases where the only thing possible is to sell the assets and wind up the business. We try and help owners to understand how to avoid that scenario as much as possible, because if you merely sell the assets and wind up the business, you're not getting the big valuation that you would have if you had the more solid foundation. We're talking about the 7 different options that were available for exiting a business. And as you can see, there are many, many different options. And there is no one right option that suits each business owner. And that's where the advice of an expert who has experience in dealing with different business owners can really add value to help you to identify which option might be the most valid option to pursue, and to help you in terms of any of the advanced planning that is necessary in order to achieve the best outcome. Next slide, please, Aaron. The sale process. If you are planning to sell your business to a third party, there is a proven sale process. And the sale process typically starts off with interviewing and engaging an intermediary, someone who's going to help you to sell the business. And the role played by the person who's going to help you to sell the business is to basically establish the value for the business. And that's very important, because if they establish a value and they tell you what the range-bound value of your business is, it will set the expectations so that you're not disappointed with the outcome. It's very important that the intermediary meets your expectations, and clearly the valuation and the value that they achieve for you is going to be important to making you a happy seller of your business. The intermediary also is going to prepare a confidential information memorandum. This is basically a selling booklet. It's looking at the history of your business, looking at the facts and circumstances of your business, and looking at the future prospects of your business, and building a document that they could show to prospective purchasers to kind of sell the sizzle around your business, sell the opportunity that lies ahead for a buyer of your business. So once that confidential information memorandum is prepared, they can create a marketing plan. They can identify lists of potential buyers, and typically they're going out quite far abroad to identify buyers. They're looking at buyers from the United States, Canada, Europe, Asia, wherever there might be businesses that are already in the industry that you're in who could be interested in establishing an investment in a business in Canada. They'll reach out to them, and on a no-names basis, solicit expressions of interest, where they can then sign an NDA, a non-disclosure agreement, to provide greater detail, solicit bids. And frequently what these intermediaries are doing today is creating an auction where they're getting you multiple bids from multiple buyers so that you can decide which buyer you prefer to deal with in negotiating the transaction. And then once the transaction has been signed, the financing takes place. TD Bank and Scott Galbraith's team very happy to help in terms of financing the transaction, in terms of the sale, whether it's a management buyout or a sale to a third party, or even if it's a family member buying the business, TD Bank is there to help you every step of the way. Next slide, please. Aaron, thank you. Challenges for a family business. Family business transitions are some of the most complicated transitions that we encounter, because very often there's a lack of family vision, goals, and values. There are different needs and perspectives of family members, lack of communication and trust among family members, a lot of emotion, as you all would be very aware of. Resistance of the founder to change or give up control. We see that so much, where the founder basically took all the risks and is so hands-on that they have difficulty giving up control. Sibling rivalry and conflict among potential successors. Lack of preparation and training for the heirs to take up leadership roles. Limited capital to fund both the family and the business needs. Increasing market competition, and lack of coordinated family business succession planning. And that's where the role of a business succession advisor and a family enterprise advisor adds such tremendous value. We're aware of the techniques and corporate governance mechanisms that families can use to try to iron out some of the issues to prevent them from interfering with a successful business transfer. Next slide, please. Harvard Business School created a concept called the three-circle model. And it was two professors at Harvard that came up with this concept. But what they did was they identified, in the context of a family business, there's three different circles of personality that have to be taken into account. There's the family members who may or may not be involved in the business and owners. There's the business management, and then there's the ownership, the owners of the business. And in fact, these three circles overlap, create a diagram where there are 7 different perspectives that are involved in the decision to exit a business at the end of the day. There are people in the family who are not owners and not managers. As I say, there's people in management who are not owners and not family members. There are owners who are perhaps not family members, not involved in the business. And then you get all those overlaps. And for each of those 7 different groups, one has to be aware of the impact on the transition strategy on those different groups. and trying to anticipate their interest in seeing a successful transition. Again, family enterprise advisors understand the complexities and can talk you through it. Next slide, please. I'm going to turn it over to Aaron Gillespie now to talk about some of the estate planning and advanced tax planning considerations in connection to a business succession transition. Aaron, over to you.
Great, thank you, Jeff. All right, we're going to test my skills here in terms of speaking and starting my video and navigating the slides all at the same time. I'll do my best. So as Jeff said, I'm going to speak about estate planning. And this is not something that's done at a particular stage in life. It's an ongoing and evolving process, and as such, business owners should always be revisiting their estate plan. Before I get started, I will take a moment to insert my legal disclaimer, as a number of the topics that I'm going to discuss are both of a tax nature and a legal nature. And although I am a tax professional, I am not a lawyer, and thus you should take my comments in the general sense or general nature. So what is estate planning? Estate planning is the organization of one's affairs in order to pass their wealth to their beneficiaries in a timely and a tax-efficient manner. And there are various planning techniques with respect to someone's estate. Probably the most common technique is the updating of your wills. When reviewing your wills, there are a few main items that should be considered. Firstly, choosing the appropriate executor. The executor is the individual who will execute the deceased's wishes as laid out in their will. When choosing an executor, they don't have to be someone who is in the business of finances per se, so you don't need to ask myself or ask Jeff to help in this regard. Jeff and I have probably been asked too many times as it is from various friends and family members. The executor should be someone who you trust and who is organized and who is willing to undertake the duties associated with being the executor. The second significant feature of the will is the beneficiaries, and these are the individuals or charities who will inherit the deceased's assets. Lastly, in terms of main features, I would suggest providing for guardianship of minor children and the allocation of those assets to the beneficiaries is extremely important. If you haven't revisited your wills in some time, I would encourage you to do so. I'll mention a planning technique that exists whereby an individual may have multiple wills. This is generally used by owners of private companies to reduce Ontario estate administration tax, which was formerly known and commonly known as probate fees. Generally, the technique involves having assets which are subject to probate in one will and assets that are not subject to probate in the other will. The assets not subject to probate include shares and debts of private companies. Where all these assets were otherwise in the same will, then probate would apply to all the assets. The savings associated with this technique can be significant, since the tax can be approximately 1.5% of the fair market value of the assets. So say $15,000 of tax on every $1 million of fair value. Next on the slide is trusts. Trusts, there are many types of trusts that individuals may use as part of their estate planning. I'll mention a few. Family trusts are used for multiple purposes. However, generally, they are used to assist in providing for the flexibility with respect to the ownership of assets and the allocation of the annual income earned from those assets among beneficiaries. These trusts are created while someone is alive. And we'll give an example later in the deck as where a trust is used. An alter ego trust is generally a trust that is settled by an individual who is at least 65 years of age, and the individual transfers certain assets to the trust. The individual remains entitled to the income earned on the assets while they are alive, and the assets of an alter ego trust are not part of the individual's estate and are not subject to probate taxes. In addition, since the assets are not part of the estate, they will not be part of the public record, and thus the alter ego trust is often used for the privacy associated with it. There are other benefits, including asset protection, as the assets are no longer owned by the individual, but are instead owned by the estate. And another benefit is that the assets may be protected from estate litigation matters. The third type of trust noted on the slide is a joint spousal trust. This type of trust is the same as an alter ego trust, with the exception that the individual spouse is also a beneficiary of the trust and thus may benefit from the income earned by the trust on the assets. Next is powers of attorney. This is an extremely important feature of an estate plan. This is the document that provides one or more persons with the authority to manage your finances on your behalf. In addition, the same person or different persons may be your power of attorney with respect to non-financial decisions, i.e. with respect to your personal care, your health. Philanthropic planning. There are a number of planning techniques related to charitable giving. Firstly, it's important to plan how and when donations will be made. Charitable donations allow for tax credits that can generally offset taxes of approximately 50% of the amount of the donation made. Thus, they can be very valuable. However, in order to realize this benefit, there must be taxable income in order to have the credit offset the taxes otherwise payable on that taxable income. As a result, consideration should be given to how and when the donations will be made. Another planning technique with respect to donations is the donation of public company securities. Where public company securities are donated rather than cash of the same value, taxes can be significantly reduced. This is because the taxes associated with an accrued capital gain on the public company shares is eliminated when the shares are donated. This can provide significant value. However, it requires upfront planning and thus should be considered as part of the estate plan. Shareholders' agreements. Shareholders' agreements are extremely important for those who are shareholders of private companies where there are multiple shareholders. There are a number of features of shareholders' agreements. However, as it relates to estate planning, it's important that the agreement deal with what happens to the shares upon the death of a shareholder. For example, the remaining shareholders may not want to have the beneficiary of the deceased estate to be a shareholder of the company. As such, mechanisms may be included in the agreement to facilitate the buyout of the deceased shares. Insurance. There are multiple benefits to insurance, to life insurance. One of which is providing liquidity in order to buy those shares of the private company that I just mentioned. It can provide liquidity to the business to facilitate that planning. The liquidity created by life insurance can also be a benefit to assist in the division of assets to beneficiaries and ensuring equality among beneficiaries. For example, private company shares might be a very significant asset in the estate. And perhaps those shares are going to one of the beneficiaries, maybe the beneficiary who is directly involved in the business. If the shares have significant value, it may be difficult to achieve the objective of ensuring that the other beneficiaries are treated equally. This is where the liquidity from the life insurance can help. Another significant advantage that may exist is providing a method to tax efficiently transfer assets held within a corporation to your estate beneficiaries. Because we don't have a lot of time together today, I won't get into the details of how this works, but again, it can offer a very tax efficient solution to transferring assets held within a company to your beneficiaries. The last item on the slide is the use of joint accounts and beneficiary designations. These are generally used to, again, reduce probate fees, as they can allow for the transfer of assets through the legal title of the asset as opposed to transferring ownership through the deceased estate. Business succession. Jeff spoke about a number of ways in which a business owner can transfer their business. As you can imagine, this is generally a taxable event for tax purposes. And as such, this comes with an opportunity to implement tax planning solutions in order to minimize the associated taxes payable. These are not all the opportunities that exist, as there are numerous more. However, these are some of the more common strategies that should be given consideration. Firstly, Canadian taxpayers are allowed a deduction against capital gains realized on the disposition of shares of private Canadian companies meeting certain criteria. Generally, the deduction is currently able to offset a capital gain of approximately $883,000. For certain qualifying farming or fishing property, the deduction is up to $1 million. Planning should be considered in order to utilize this benefit multiple times in a family business context. This is done by having a trust be the shareholder of the company or by having multiple family members own shares of the company. This can result in significant tax savings, as each deduction can offer tax savings of up to $236,000 per individual family member. Next is where the company has a capital dividend account balance. The corporation is allowed to make a tax-free distribution of any amount in its capital dividend account. The capital dividend account represents the untaxed portion of capital gains, as well as the proceeds of life insurance received on the death of a life insurance policy owned by the company. The company can pay out the capital dividend account balance tax-free before the exit of the shareholder. Pensions. Corporations can fund pension and employee benefit plans on behalf of their significant employees. It is worthwhile looking at whether the company can make a past service pension contribution for the owner's benefit in order to enhance the owner's pension entitlements, again, before they exit the business. Lastly, at a certain point, business owners may consider implementing a freeze of their interest in the business. So a typical estate freeze is a mechanism whereby the owner caps the value of their interest in the business at the current fair market value and allows any future increase in the value of the company to accrue in favor of other individuals, most likely their family members or key employees in the business. The most significant advantage of the freeze is the resulting cap on estate taxes payable by the owner on their death, since the value of their interest in the company will no longer increase following the freeze. This results in taxes associated with the increase in value of the company at that time not being payable by the owner, but instead being payable by family members on their passing. Where those family members are significantly younger, this results in this tax being deferred perhaps decades longer. And as most people know, deferring the payment of taxes can result in a significant cash flow advantage. I'll give you an example on the next slide. This is a picture of a typical estate freeze situation. So in this picture, generally what is happening is the owner is exchanging his or her growth shares in the company for shares with a fixed fair market value. The shares the shares that are entitled to any future growth in the company are then held by a family trust in this example. There's a couple of features on the slide that I'll note. And firstly, besides where the value is attributable and thus the underlying taxes are attributable, is the control. The control is maintained by the original owner, as his or her shares will be voting shares. There's another note at the bottom of the slide to be aware of, and that is the impact of the new tax on split income rules, which make it more difficult, but not impossible, to split income among family members. So these rules need to be given considerable consideration as part of the implementation of this strategy. I'll cut it off there and I'll hand it back to you, Jeff, for the last slide.
Thank you very much, Aaron. TD Bank launched a business succession planning service at the end of 2011. We have now rolled it out across Canada, and basically TD has skilled specialists on hand to sit down with you and help you to understand some of the options that are available to you and try to introduce any specialist parties that are needed to help you to complete the successful transition of your business, whether it be the ultimate disposition of your business, the financing, and the tax and estate planning. So to the extent that, that you want to find out more about business succession planning, please reach out to Jennifer Monaco, who is the account manager covering the Niagara region. And Jennifer will be able to help you to get in touch with some of the specialist advisors within TD Bank. So with that, I'm going to turn it back over to you, Mishka.
Thank you very much to both of you, Jeff and Aaron, for such an informative, actually, approach to it. It's really appreciated. We're now going into this part of the session that's actually addressing the questions that have come forward by many of the people who are in attendance today. I also wanted to say to all the participants, if you are interested in asking a question, but knowing that this is estate planning and succession planning is such a personal matter, and you might not want to have your name or your organization's name released. If you have a question, please feel free to use the chat version. The chat is at the bottom where you can type in the question, and only the panelists will see it. None of the attendees or participants actually will see your questions, so we can get to that as well. So that is an option, but if you also, another option is, as always, there is a hand symbol. If you touch there, we know that you have a question and we will unmute you. So thank you very much. So let's get started with some of the questions that have come forward via social media and email to us over the last week. So one of the questions that has come forward has to do with actually COVID-19. It has changed the number of business owners, or actually let us ask you this, has it changed the number of business owners seeking to exit their business at this point? And what does that mean to those looking to sell their business or hand it over to a family member or just leave and retire? Where do you see the impact of COVID-19 on actually taking a look at succession planning? And maybe, Jeff, if I can pass this question on to you first, and then over to Aaron. Jeff?
Thank you, Mishka. Interesting. I thought that COVID-19 would have an absolute awful effect on the extent of interest in pursuing mergers and acquisitions transactions. And in fact, I have at least 3 on the go right now that have arisen since the inception of COVID. Now, why has that happened? Because good businesses are still very much in demand by buyers sitting on the sidelines with cash. And they're actually looking at this as an opportunity to take advantage of COVID to some extent. And it hasn't hindered the value that much of the business. So there are certain businesses, and I did say this in the presentation, certain businesses, Mishka, that have in fact prospered during COVID. So if you're in the food business right now, food businesses, for example, have been in high demand. And in fact, their profitability is increased over what it was before COVID started. So that's an example of a business that if you wanted to make an acquisition in the food business, this would be a great time to be buying a food business because they're doing wonderfully well. You're not having any crippling effect by COVID. There are other businesses that have been seriously affected by COVID, clearly. If you're in the amusement industry, if you're in the hospitality industry, your earnings and profitability have been impaired by COVID. And perhaps this is not as good a time to be exiting your business because you don't have the same profitability. So of course, on a case-by-case basis, it depends on the business and how well they've been able to survive COVID. But I can tell you that the M&A industry is still going strong right now.
Yeah, no, I appreciate that. And I think we've seen the same. We see a lot of goods producing industries actually doing quite well. They are coming back and they are stronger, whereas others will take longer to one. But that probably also creates an investment market at the same time. But Aaron, to that question, how has COVID-19 changed the number of business owners seeking to exit? What is your kind of take on this?
Yeah, I would say very similar to Jeff that I am surprised as well with the amount of activity in the market. There's still lots of opportunity out there. There's lots of cash out there, lots of both strategic investors and private equity, which Jeff talked about, looking to deploy money. And so there's still lots of activity in the M&A market, which to Jeff's point is a bit surprising. I will say on the negative side, there's no question that an owner that whose business has been negatively impacted, that owner is definitely assessing their situation right now. Do they want to go through another business cycle with a slow economic recovery, which at this point in time, I think that's kind of where most people are leaning, that it will be a long and a slow economic recovery. So that type of business owner definitely, Mishka, is reassessing their situation and do they want to stick around for that long recovery period.
Yeah, thank you. And this is a question that came forward too, where someone asked, it's like, how should they look at, they had done some previous planning to sell their business. They kind of had thought maybe in the next year to 2 years. But what are some of the key factors for assessing if the time is right now or in 2 years down the road? What are some of the key elements that they need to ask themselves? Because sometimes this is hard. This is a hard business time. It's a hard business climate. And maybe they are now faced with the decision, should we stay in business for a little while longer? What does longer look like? Do we need to try to rebuild it, sell it, or close it early? These are all key, but what are some of the key factors, Aaron?
Yeah, so I would say certainly they need to assess how they've been impacted by the pandemic and look at their business plan and look at how their business plan may have changed, how they need to pivot, what are the changes they need to make to their business to operate in a new environment. There's some things that, you know, will probably be changed forever as a result of the pandemic. And so, that would be the first thing I would say is they should look at their business plan. I do want to maybe slide in a positive opportunity that's been created as a result of this. And that would be that where the value of the business has declined and they're able to support that in valuation, methodology, there could be an advantage in the fact that I talked about that estate freeze opportunity. They could freeze their value of the business at a lower market value and thus take advantage of that opportunity to have the upside on the recovery accrue in favor of their next generation, in favor of their family members. So, that's a positive to the negative.
But actually, I totally appreciate it. Jeff, your take on this question?
Yes, I think we've always recommended to business owners to plan early, Mishka. Why is it important to plan early? Well, Aaron talked about some of the tax planning that does require a certain time frame to take advantage of the tax planning opportunities, like the lifetime capital gains exemption, for example, requires a 2-year hold of the shares before the disposition takes place. If you're adding additional family members, so that in advance of a sale, you want to position it to be able to multiply the use of that exemption. But similarly, if you have a longer window, you have the ability to apply different techniques to enhance the value. For example, you might make an acquisition of another business in your industry to grow the profitability. This is a wonderful time to be looking for acquisitions because possibly some of your competitors are not having an easy time and maybe they could be bought out at a better multiple today. And by growing your bottom line, you're going to push the valuation of your business into that next threshold because like we talked about earlier, that pyramid, if you're able to push the profitability up the pyramid into an area that there are fewer businesses, you'll command a higher valuation at the time of exit. So I think that by having an expert work with you and help to evaluate and validate the exit strategy, I think probably you'll get some good ideas to enhance the value and reduce the tax burden on the ultimate disposition.
Yeah, that really, I appreciate that. Jeff, your background is working on the international stage of it. If a business is a multinational, binational, international business, will the answer look differently? Will the opportunities look differently because of so much of a supply chain being disrupted, uncertainty about border issues and others? Is an international business, do they need to look at it differently than maybe a local one?
You know, it's interesting. I've dealt with businesses that are locally established in countries as far away as Nigeria. You know, I had a client resident in London who owned a business in Nigeria, and that's where he spent his working hours while his family were living in London. And his business was focused on food production in Nigeria, and he had a wonderful. It depends very much whether or not it's a business that is operating in the foreign country, but that is actually having some type of a distribution strategy or an acquisition strategy of its raw materials from another country. Absolutely, logistics have been affected by the COVID. And absolutely, I think there is a movement today, Mishka, interestingly enough, to start to source product domestically. I think there's been a wake-up call now to realize how difficult it is to rely on a supply chain coming from foreign countries when we have something as terrible as a COVID. And so there is going to be an increased focus. And that's why, in the context of the real estate market, for example, they talk about the demand for industrial real estate actually rising post-COVID, because there's going to be a lot of businesses that want to establish a facility here in Canada to manufacture and distribute for supply chain reasons, because people who need goods and services are going to want to acquire them locally.
Yeah, makes full sense. There's a huge initiative, huge movement to buy local, to buy Canadian, and especially when we take a look at agri-food and other areas of it as being key sectors, medical supplies, and so on. So yeah, we are seeing a real shift in the growth in some of those areas. Here's a question from one of our attendees, and they asked, is it still possible to find investors in the current climate, and if so, where and how? Aaron, what would you say? Where should they go and where should they look?
Yeah, and I think, Jeff, you touched on this in your presentation. Yeah, absolutely. As we said, there's still a climate for mergers and acquisitions. Lots of activity still out there. And as Jeff and I both said, we're both surprised by the amount of activity, the level of activity. Where to go? Definitely seek advice from those professionals around you, lawyers, accountants, M&A advisors, brokers, bankers, etc. Start with that team of professionals that you've assembled around you, and whether they're the right people or whether they can put you in touch with the right people, they're your go-to team first. And so go to that team that you've assembled around you.
Yeah, sounds good. We've got a question coming in from Mark, and I've just unmuted Mark, I believe. Let me think. Yeah, he's unmuted. And Mark, we can hear you. We're looking forward to your question.
Great. Thank you, Mishka, Jeff, and Aaron. In my particular case, in my family's business, we own liquid assets in the form of land and private company shares. And forgive me, I'm a little new to all of this, but my concern is with regards to what seems to be the 21-year deemed disposition. So I'm thinking about the fact of what can be done to reduce or limit capital gains with that in mind? And how does this factor into succession planning as well?
Okay, so Mark, I think you're referring to the 21-year rule as it relates to trusts. So for those, and correct me if I'm wrong, Mark, but for those on the line, a trust is deemed to dispose of its assets every 21 years and therefore would realize any accrued capital gains that it has on the assets that it owns. And in your case, Mark, that might be shares of a private company, as you articulated. And so that is an important rule that needs to be navigated. And there are strategies to navigate that, Mark. And so, for example, I'll give you the most common strategy, which would be taking the assets of the trust and distributing them out to beneficiaries. And as long as certain conditions are met, Mark, that can be done on a tax-deferred basis. So without tax on that disposition of the assets by the trust to the beneficiaries. So that would be the most common technique that would be used to mitigate the tax associated with that rule. So yes, there are absolutely strategies available to ensure that when that 21 years comes about, there is no tax actually payable.
Thank you very
much. Mark, if I can add
yes.
something to what Aaron has said. Usually, in order to have the home run solution, not only do you make the election to roll the asset out of the trust before the 21st anniversary, which, as Aaron said correctly, can be rolled out on a tax-deferred basis, but because the beneficiary of the trust is going to be receiving an asset with high fair market value and low cost base, it is common to also have the corporation, a holding company in that corporate group, buy a life insurance policy to actually cover the taxes that will be arising on the death of that beneficiary, where the deemed realization will be triggered, that deemed disposition. And this will permit the perpetual transfer from generation to generation of these assets. It's also possible to refreeze an asset. So once the asset's been rolled out to that beneficiary, they can refreeze it for a further 21 years for their next generation as well. But the combination of the rollout from the family trust together with the life insurance is a home run to be able to both allow this to be taking on a lead back on death.
Yeah. Thank you very much. We have another message or question coming in, and this is: if a family trust is established with shares issued to the holding company owning assets and the holding company owning the business, what is the best way to ensure succession planning with the children? The family trust has the children as beneficiaries. However, should shares be issued to the children at any point, and the current founder and owner of the family trust holding company and business is retired, but is involved in day-to-day operations because the children are in different provinces until the business is operational. It's currently not producing the products that they have, but it will happen in about 2 years of time. Jeff, what would be your suggestion there?
It's really Aaron's area of expertise, but I'll just add my 2 cents before I turn over to Aaron. And the 2 cents I'm going to say is under the income splitting restrictions that exist now under the COSI rules, it's no longer possible to pay dividends to shareholders who are going to be having their shares held by the family trust. The family trust is extremely valuable for the multiplication of the lifetime capital gains exemption, but provided you can get more than 10% of the votes and value of the shares in the hands of the individual family members as shareholders, you'll also be able to pay them dividends and do some income splitting for them. And I'll turn it over to Aaron just to really describe how the distinction is between owning shares under a family trust and owning the shares outright by the family members.
Yeah, and thanks, Jeff. I'll add to it and just say that firstly, it's a pretty complex question because there's a lot of layers to it. You know, really what you're talking about here is a classic family business scenario. And so I'll just lead out by saying, you know, there is no right time. I think the individual's asking, you know, when is the right time and that sort of thing. And I would say there is no right time, but the word I would use is communication. So I think all the family members in this case need to be talking about what the plan looks like. How will the business operate? How will the business be owned? Why it's operating that way? Why it's going to be owned that way? You know, just as we said with Mark, certainly the shares of the company could be distributed out to the children from the family trust. However, you know, considerations like control should be thought of. You know, does the current owner want to maintain control? When do they feel it's the right time to transfer control? But ultimately, what I think the individual is getting at is to say, when the shares are transferred from the trust to the individual beneficiaries, at that time, those beneficiaries own those shares. And that discretion is now taken out of the equation, where in the trust, it's fully discretionary, where annual income will go, where the value associated with the shares will go. You know, that discretion is then taken out of the situation. And now the individuals own those shares and they're entitled to all the benefits associated with those shares. So when's the right time? There's no right answer to that, no wrong answer to that, but I think it just comes back to communication within the family.
It's also possible to have a shareholders agreement. You know, usually when there's a freeze that takes place, the founder or the person who's the freezor will have the voting control shares. And if there's a shareholders agreement that is put in place before the shares are transferred out of the trust into the hands of the individual children as shareholders, then the founder still has control, and the shareholders agreement will be able to define the restrictions over those minority shares that are passed out to the children to hold directly. It's also important to analyze whether or not it is in the family's best interest to have those shares continue to be held by those individual family members who are not working in the business, or if it makes sense to actually have a strategy to buy back those shares at some point in time, perhaps using life insurance, to be able to have the operator of the business ultimately have the ownership of those shares, because the operating CEO, the child who's taking over the business, will probably want to have full control at some point in time down the road.
Yeah, no, it really makes sense. I'm conscious of our time, and I promise to give each one of you a minute for closing remarks. We have quite a few more questions coming in, but what we're committed to is that some of the questions we'll redirect them to your organizations and the key people within your organizations that we have. But looking at the time for Aaron, would you like to start out with some closing comments?
Yeah, I'll just really quickly say that, you know, this is an area that's extremely important, whether it's succession of the business, estate planning for the business owners. Very, very important that you again communicate. I think that's the biggest downfall, and I'm glad that that question came out at the end because it's a nice segue into, again, the word communication. I think that's the biggest downfall we see in family businesses is the lack of communication, and it leads to eventual problems. And I think often what we've seen is people suggest, well, that's not really my problem, I'll be gone, you know, we'll let them deal with it. But I think that's not setting people up for success. And in order to set people up for success, which I think ultimately is what everybody does want, in my view, it's all about talking, it's all about communication. And so I'll leave it there to just say, I encourage people to talk about these things.
Yeah, I think it's a key aspect of it because there's so many questions even coming in that people have, and I think it requires dialogue. Jeff?
I'd just like to say that it's been a great pleasure representing TD Bank and working with the wonderful clients of the bank where we've been able to add great value. And I'd encourage the audience of your members to turn to the bank because there's a lot of resources that are available through Scott Galbraith, Jennifer Monaco, and the team. They can bring to the table to help your members be better prepared for the future.
Yeah, I appreciate that. A couple of the attendees have also asked for us to share Jennifer's email, which we will do right afterwards, as well as the presentation deck. There's a lot of interest there in the information that you shared in your presentation. So on behalf of our attendees and on behalf of my colleagues, Jeff and Aaron, thank you so very much for being with us this morning. This webinar has been recorded and will be available on our website at gncc.ca and will be emailed to all the participants who are with us this morning. And to all the attendees, thank you so very much for being here. These are difficult choices to make for your organization, but most critical in being prepared. If you have any further questions, please feel always free to reach out to us directly. We can be reached at info@gncc.ca or mishka@gncc.ca, and we look forward to hearing from you. Lastly, to everyone, thank you for joining us. Please stay in touch and above all, stay healthy. Thank you.